Okay, let's talk about the broader view on the markets from a local investor's perspective. We have Ritu Arora, who's CIO Canara HSBC OBC Life Insurance, joins us on the show right now. Ritu, good to have you on the show, and thanks very much for taking out the time. First up, what's your broad view post the budget from a market standpoint?
It's a good budget, balanced budget, credible budget. The fiscal deficit targets as well as growth has been balanced out reasonably well. RBI followed up with a very positive cut for the markets. But these are macros which are falling in place, and I believe a lot of macros look better than they ever did in recent past. But the fact remains that it's an expensive market. We are 20 times forward, and that gravity cannot be defied. And that is the headwind that the market is facing with every high. And I believe market is likely to be range bound. There's no real reason for a runaway market or a big bull run from here. And for the next few months, market will have to find its space, and it'll be a range, I think, between in plus and minus 400-500 points from here, depending on events and inputs that come along. Till corporate results improve, which I hope will improve towards the end of this year, market after which will take a direction. So long-term bullish, but short-term I believe market will remain range-bound.
Okay. Would you begin investing in infrastructure given the focus there in the budget?
Infrastructure bonds are definitely an investment opportunity. I think the market will welcome them. As far as equity investments go, yes, an investment opportunity, but we'll have to discern between different companies. So it is not a broad infrastructure cap goods market sector call, because each company have very different fundamentals at this point in time. Most of them do not reflect any improvement in their volumes and numbers, and hence a bottom-up analysis is warranted. So while I would be bullish on the sector, but not secular, it requires a selective stock selection.
Is the rally in FMCG and durable consumer goods due to GST implementation? Is that the rub-off that these stocks are witnessing?
A part of it, yes. Also, these are stocks where you still see volumes and you see some kind of earning visibility. They are also seen as the defensives. So if the market is not getting bullish, then defensives will perform well. And anyway, over the next few months, I anticipate that we'll see a lot of sectoral reorientation. We will see stock-specific rallies. So it's not as if, while the general market as an index may not take a bullish direction, but sectoral rotation will be the order of the day. Stock-specific returns will be high. And hence a balanced portfolio is warranted, and consumption does find a way hence into all the portfolio managers' portfolios.
What's the view on NBFCs and the private and the PSU banks essentially post the budget, all the financials, Ritu?
Financials is a very important space, and it will be reflected over the next couple of quarters as well. It continues to be a dominant part of the indices. Having said that, private sector banks continue to look better positioned than PSU banks. PSU banks, besides the NPA challenges, also have the challenge of lesser capital allocation in this budget, and they'll have to probably, and we all know that they're capital deficit, which means they'll have to tap the markets for capital, which is going to be challenging given the state the balance sheets and P&Ls are currently. So hence, I prefer private sector over PSUs. I continue to do so. As far as other financials, NBFCs, yes. There are a lot of things in the budget, including gold monetization and a host of other things that you already mentioned. So one will, there it's not a secular call, but selectively NBFCs as well. But already banks and financials are over a third of index, and I expect that to continue, and hence they will form an important part of all portfolios.
What are your broad sector likes and dislikes at this point?
I'm running a balanced portfolio, so we did not discuss IT, but IT still finds a good place in my portfolio. It is one sector where earnings visibility is intact. I still like pharma. I like banks and financial services. I'm a little wary of late of my exposures in cement. I would of automobiles. Infrastructure and cap goods remain to be a favorite, but with specific stock selection.
Okay, and when do you think, I mean, we'll let you go, Ritu, now, we're just getting done on the show, but when do you think corporate earnings pick up? What are the expected earnings estimates for FY16?
It's $1 million question. I wish I knew the exact answer, because that will really dictate the trajectory of the market going forward. At this point, as we discussed, we're 20 times FY15, which is a fairly expensive market, almost 17 times FY16. So I would hope that we'd have an earnings growth in FY16 of about 12 to 13%. But the indications as of now seem to be in higher single digits, 8, 9 kind of a percentage. And over the next couple of quarters will tell us if we can expect any better. And hence, like I said, that is a gravity which will keep the markets grounded and will not support a big bull run.
All right, that's a local opinion from a domestic investor on the markets. Thanks, Ritu, very much for joining us and giving us that perspective. But from an investor in the local markets, let's talk about how some people outside of the markets keep a keen eye on what's happening in the world. It is an early weekend and we have actress Janelia Deshmukh